Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. The higher for longer camp found some more campers yesterday after the US GDP data for the first quarter was revised higher to 2% versus 1.4% expected. This, alongside the jobless claims data, led to some surge in the US yields. The Chinese yuan continues to remain in the spotlight as it continues to weaken and currently testing some crucial levels as well as being under watch by the regulators. Domestically, investors rejoiced on Wednesday as our equity indices hit all-time highs. Good morning, JK. Lots of data. How has the US data changed the investor expectations and thoughts on Indian equities? Keen to hear your take.
Hey, good morning, Swaraj. In fact, since we closed trading in India on Wednesday, a lot of things have actually happened. We had many central bankers speaking at the European Sintra conclave, and yes, it was Powell's statement, which was not a surprise, but he continued to stand pat on his need for more action on the rates, and is not ruling out hikes in two consecutive meetings. As far as Europe is concerned, I think Lagarde was somewhat slightly less hawkish in her statements, and she said that if the data show higher inflation in July, rate hike will be there, but nobody is committing about what is going to happen beyond July in Europe. In fact had even the Japanese central banker speaking about the economy is doing slightly above potential for some time, seeing signs of inflation expectations rising, and if we become reasonably sure about second part of inflation forecast, it would be good reason for reconsidering policy change. That is a big thing that is coming from BOJ, although yen has not reacted much to it. And then Bailey from UK actually said that rates would remain higher for longer, as you mentioned in your opening statement, higher for longer. So higher for longer is anyway is given, but who is going to go next on the pause is what is the question mark, because inflation data itself has become quite volatile after rising sharply in the month of April and May in Canada and Australia. Inflation has again started to come down there. In fact, Australian inflation dropped quite sharply, and once again from hike to pause, then pause to hike, and then once again we are looking at the possibility of another pause by these central banks. But that's really keeping the investors on a very suspenseful state of affairs. As far as US is concerned, at least there is no ambiguity. July hike is close to 90% probability, and in Europe, as I said, the July hike is definitely on the cards. But if you look at the numbers that have come yesterday, you see the US growth once again showing resilience. GDP growth coming at 2% versus 1.3% that was expected, and growth coming through maintaining high level of consumption, as well as exports doing well, imports dropping, and that's a good sign. And so if you look at the jobless claims, they dropped to 239,000. Earlier markets were expecting lower number, and they were getting a higher number in early part of June, and then yesterday they were expecting 265,000, and it came 26,000 lower. So really putting the forecasters really on a very on the radar as to how credible they have been. Of course, there are some special factors which are mentioned for the rise earlier in the month of June for the jobless claims, but now again job market showing some resilience. So overall, the US economy, at least for now, is not showing signs of recession. It is only the expectation of recession. We keep talking about the yield curve inversion, but really the ups and downs of the economy is not really confirming that we are anyway very close to a recession or something like that. More on the data, in Germany, inflation rose after dropping for 3 months in earlier, and then this rise was partially due to base effect, unfavorable base effect. That is what is mentioned, and authorities are saying that going forward the inflation will be easing, and in fact the Spanish inflation was lower than expected. So it's not as though the European inflation is running away to the higher side once again, but definitely European data is confirming the economy is struggling, and therefore finally yesterday euro relented, going below 1.09 and staying well below it, but still it's not running away to the downside. In fact, dollar index has huge resistance at 103.5, and that is stumbling block for gains towards 104 and beyond. And for euro, break of 108 on a consistent basis would be way on the way for 1.06 in my view. On the other currencies, yen is at a very, very sensitive point at 145, where earlier Bank of Japan had intervened. So market really remains a bit nervous, but fundamentally things have not changed because US yields are going up, so yen will be sold more for buying dollars, at least from the short-term players. On the euro also, the euro yen is marching ahead, though euro has fallen because eurozone yields are still attractive for the Japanese investors. On the yuan, again, the fixings have been lower, indicating authorities' displeasure at one-way weakness of the yuan. There were 2 consecutive days on which the state-run banks in China were seen selling dollars, but it has had no effect because we have again seen a new low for the yuan in this cycle. Therefore, I think currencies are in a way not moving uniformly, but taking cues from their respective economies, and Japan and China definitely going with the weakness of their economy, as well as the low yields that they are offering to the investors. UK pound is quite resilient, not going below 1.26 despite the strong US data. Now, definitely we turn our attention to Europe zone preliminary inflation report for June, and expected to be slightly higher, and then US PCE core inflation, where month on month is expected to be slightly lower by 0.1%, but year on year is expected to hold up at 4.7%. So any downside surprise could see yields retreating. In fact, talking of yields, yesterday we had big jump in yields across the tenors in US. 2-year yields have gone above 4.80, and that was holding generally for a long time and closed at 4.88, and that is actually a breakout from the consolidation that we had seen. Maybe we are headed to 5.08 in the near term, unless there is a big downside surprise in the PCE core inflation. Eurozone inflation also just backed up, went up following the US yields, and also the German yields going up. US 10-year and 30-year were also seeing a good jump. So with a lot of issuances lined up from the Treasury, I think US yields are very well supported, and stronger data in the coming days can only see the yields even higher, because people have been buying bonds around these levels earlier, and till Wednesday, in fact, they have been buying bonds, even ignoring Powell's comments. But I think yesterday's move up is somewhat unnerved the buyers, and possibly more stronger data can lead to a lot of selling in the bonds. And on the INR, of course, there is very little to speak as far as the intraday moves are concerned. We are confined in a very narrow range, but factors to look for today would be forward premium, which can come down again because US yields have shot up. So we may once again see the premium, 1-year premium dropping closer to 140. And we might also, of course, the stock market holding up on highs, new highs, is a good sign, and the risk sentiment is definitely overall positive in the global markets, and that will actually feed into the Indian stocks, and investors will be, of course, encouraged to buy more stocks. So there's nothing negative that the Indian markets have to contend with, although there is some concern about valuation. So that will only result in a slow movement upward rather than a roaring rally. So we will see markets remaining supported and corrections being shallow unless something very negative develops, of which there are no signs as of now. Thank you.
Thank you, JK. And what's interesting from the central bank speeches is countries which hiked after a pause, like Canada and Australia, which are seeing good drop in inflation now. So the question is, will they go on a pause again? While US growth is showing good resilience, good consumption, good trade balances, and there has also been a drop in jobless claims. One more important point is from the Japanese yen, which is at a previous intervention level of 145, while on the Chinese front, yuan's fixing has again been lower, possibly indicating a displeasure by the central bank of the continuous depreciation. Key data point today will be the US PCE, while on the rupee front, forward premiums again might drop due to a rise in US yields. That's it from us today. Tune in on Monday for another round of fresh updates. Thank you so much for listening.